No worries, ma'am.
Yeah. So we have looked into those things about we have to understand now what is foreign exchange risk, and we also will look into what is how is foreign exchange risk managed and what is interest rate risk. These are the two topics which are left here, so we will be doing that and wind up. Before we start with that, we have to also look into what are the what is the meaning of the treasury function, what is the role of treasury function. Okay. What is the role of treasury function? It looks into the banking aspect, the foreign exchange, cash and currency management, raising finance, risk and insurance, short-term asset investment. It could be centralized way of managing or decentralized way of managing. So the main functions of the treasury function are to involve in the banking related transaction, foreign exchange related transactions, investing in cash and currency management, raising finance, risk and insurance, short term assets and investments. That is the role of treasury function. You understand the meaning of these things, so you can learn on your own. Coming to what is foreign exchange risk, let's spend time on this part of it. What is foreign exchange risk? Under that, let's start with understanding what is exchange rate system. Exchange rate system is, since there are different countries, each country having their own currency. When the currency is compared, one currency with another currency, what is the value of each country's currency is what we are looking at as exchange rate. Suppose for example, if we are talking about a US dollar is worth, so $1 of US is worth how many? Roughly let's take it as in Indian rupees. If we are presenting that, this is worth 70 rupees roughly. Okay, so we see that the each country's currency has an exchange rate, and this is not fixed all the time. This is fluctuating. So when in the foreign exchange rate markets, we see that the value of currency keeps changing from time to time. So now when two parties enter into an agreement about dealing with the foreign currency, so buying and selling of the foreign currency, when they look into that, let's say there is an agreement they enter into as on today. To fulfill that agreement after a while, let's say today's date is February 1. So if they enter into an agreement of buying or selling, so this is February 1. So February 1, what, there must be some rate. Okay. Then let's say that they would be entering into an agreement to transact with a buying or selling of foreign currencies as on March 1. So whatever is the date. So during this time period, we do not see that the currency rate would be always fixed. It would be fluctuating. So we see that depending on the demand and supply, the various other aspects, the factor, the information which is in favor of that particular economy or not in favor of that economy, we see that the foreign currency keeps fluctuating. Okay. So then in that case, what is today's rate may not be prevalent on March 1. So the price may be higher, the price may be lower. So we see that there are fluctuations. If at all, if there is an agreement which they enter into at a fixed rate, then they decide on the rate that no matter whatever would be the prevailing rate. So even if it is higher or lower, let's say that they have locked it at $71. If they suppose for every $1 they have decided the rate to be as 71. So no matter what is the prevailing rate, as on February 1 or as on March 1, irrespective of that, they would have to fulfill that obligation which is they have mentioned in the agreement at this rate. So that's a fixed rate, fixed exchange rate. So they have decided on that rate. They would fulfill the transactions. Let's say that as on that particular date, if they have to make the payment would be paid at a value of taking the dollar value to be at 71. So that is fixed. So they have to fulfill that. The payment would be made as on that date at 71. But if they say that whatever is the prevailing rate as on that particular date, you must have experienced sometimes if you have transacted with any particular foreign currency transaction, like buying from an international site or something. Sometimes you make the payment in dollars. You must have come across. So in that case, what happens when you are paying in that foreign currency? As on that date, whatever is the prevailing rate will be applicable. It will not be as on an average rate or a fixed rate. As on that particular date, whatever is the prevail. I think for the ACCA exams, you see that there is a variation in that price every time you make the payment, because depending on whatever is the value of dollar, it keeps changing. You must have experienced that part. So if the agreement is fulfilled as on a particular date's rate, we call that as floating exchange rates. So there are two different types of exchange rates. Exchange rate systems are floating and fixed. Floating exchange rates are based on what is the prevailing rate as on a particular date. That would be um, floating exchange rate. Fixed exchange rate is irrespective of what is the changes. If they have decided upon a particular a rate or value, the agreement will be honored at that particular rate. That is a fixed exchange rate. But what is an exchange rate? It says that an exchange rate is the price of a currency expressed in terms of another currency. So the example what we have written is $1 is expressed, if we now the domestic currency is rupee. So rupee, how can we express that is if 70 rupees are considered, so that is worth $1. So that is how it is expressed in an other country's currency. There are types of currency risks. So what are the risks what we are basically talking about? Now theoretically you should be aware of what these things are. uh, to a very there is a very great chance of numericals not being tested here, but the conceptually what are these terms will be thoroughly tested. So you should be clear with the terms and whatever are the concepts and the meaning of all these things, because later on at AFM level, there's another paper at AFM level, you will be further tested about the numericals, but we will go through what is the content here at this point of time. There are basically here there are three different things which are mentioned. The foreign exchange risk exposure of companies can be broken down into three categories. Why are we calling it as a risk? Because risk is a variation in the expected value. So in future, if you are expecting the dollar value to be at 70, but let's say that if the $1 value would be at 70, but if let's say that it is not 70, you are expecting it to be 70, but it can rise up to 74. Let's say that. In that case, what are you seeing? You're seeing a variation. So when there is a variation in the expected value along with its probability is called as risk. Okay, that is the meaning of risk. When is there a risk? Whenever there is something which is expected and that same thing does not happen, that same thing does not prevail, if there is a variation, we call that to be as a risk. So when parties are involved in foreign currency involved transactions, when parties enter into transactions which involves foreign currency, like they are involved in importing goods, they are involved in exporting goods, or they are just trading with the foreign currency, no matter what it is. In that case, we see that at as on the date, as on a particular date when they have to make a payment, as on the date of payment, as on the date of payment. Now, how would they pay? Would they pay at a fixed rate, or would they pay at a rate which is prevailing? Let's say that two parties enter into um, an agreement of importing goods. So then when the goods are imported, as on the date of payment, what would be the payment be? The payment which is according to the rate which is prevailing as on a particular, as on that particular date of payment, or they have decided that irrespective of whatever is the prevailing rate, they would be making the payment at a fixed rate. So that is what we are basically looking into. For example, if the goods are imported, so what, how would the payment be made? So if the date is payment as on March 1st, so March 1, what will they make the payment as? Will the payment be as on the rate prevailing on March 1, or it is a pre-decided? So these things have to be looked into. Done. So there are two different types of rates. That is, they can enter into an agreement at a fixed rate, or they can enter into an agreement at a floating rate. Floating rate is as on that particular rate. So we because there are fluctuations in the currency value, you may expect that it would be 70, but if it rises to 74, then what happens? The one who's making the payment, instead of making only 70 rupees, would end up paying it at 74. It could also become 68 only. So if it is 68, then the seller who is expecting to receive 70 would be receiving only 68. So we see that the fluctuations can cause loss to both the individuals, both the parties. That is, the seller party gets affected when the value reduces, but the buyer party gets affected when the value rises. So here we see that risk aspect is involved, because the transaction is in foreign currency. Because the foreign currency keeps varying, the parties which are involved in buying and selling in terms of foreign currency, they get affected. So what are the various types of risk involved related to currency, the foreign exchange? We have three different things. So I will explain that, and then let's try to understand what are these three different types of risk. The first one is a transaction risk, second one is a translation risk, and then the third one is an economic exposure. Transaction, because they are transacting is, what do we call it as transacting? Transaction is buying and selling, because they are exchanging. It says that the definitions are given for all these three here on this side of it. What is transaction exposure or transaction risk? It says that it's the risk of an exchange rate changing between the transaction date and the subsequent settlement date. So the example just now what we were quoting is, if suppose a transaction starts on February 1, and but the finally the payment and the settlement would be made on March 1. If that is the case, see, when they enter into a transaction of buying or selling or any other thing, rendering some service or something, but the payment is on March 1, how would they make the payment? Will the payment be at a fixed rate or a floating rate? If there is at a floating rate, then in that case, whatever is the rate prevailing on the payment date, March 1, at that date, at that rate, whatever is the rate prevailing will be settled. So I explained you that yes, there is a risk involving both the parties. If the price drops, the seller will be at a loss. If the price rises, then the buyer, seller will be negatively affected. If the price rise, it is a negative effect for the buyer, because buyer will have to end up paying more amount of domestic currency. Okay, so if there is a risk which involves transaction between two parties, we call that to be as a transaction risk. Okay, second type of it is translation risk. Let's say that there is a parent company. Who's a parent company? Who owns more than 50% of the shares of another entity, we call that company, the one who owns more than 50% of shares, is more than 50% of the equity, 50% of the shares of another company, we call that company as a parent company. The company's shares which they have purchased will become their subsidiary. Okay, so these two terms, remember, there is a parent company and a subsidiary company. Now, whenever there is a parent company presenting the financial statements, it is needed that the parent company have to consolidate the financial statements. What does it mean by consolidating the financial statements? Now, just give me 1 second, one minute. Okay. So what does it mean by consolidation? The parent company has to uh, sum up both the financial statements. So parent company, XYZ company in India, let's say that XY company is there in India. So AB company is in some other country. Let's say that um, this is in China. Let's say that, for example, some company you take, some country you take, some company. Now, as on the date of presenting their financial statements, which they have to be disclosed and as on a respective date, then X company will have its own financial statements disclosed. AB company also will disclose their own financial statement. But because there is XY company is a parent company, XY company cannot only disclose or publish their own financial statement. They have to add up the transactions of XY company and AB company, add them up and then show that. How to do that? I'm putting it in very simple and blunt model that it is added. We call it at the term, what we call it as is consolidate. They have to consolidate. Consolidate is merge these two things or add them up together. The income statement of XYZ, income statement of AB company, both of them have to be clubbed together and then disclosed. Similarly, balance sheet also. There is a way in how they are valued and added. That is not part of our syllabus, so we are not getting into those intricacies. So here the consolidation has to happen. Now, because they both are in different countries, their financial statements also would be presented in their respective domestic currency. XY company will have the financial statements prepared in Indian rupees. China will have their in, what is the currency of China?
Yen.
No, no, no.
Yen.
No, it's not yen.
Yuan. Yuan.
Yuan, yeah. Okay. So, so in that case, they will have their financial statements in their respective currencies. But now when they have to be consolidated, the China company, the company which is there in China, that all the transactions which are there in their respective domestic currency now have to be translated to Indian rupees. Okay, so when they are preparing their financial statements, everything is fine, but the date when they are translating, they have to present them according to the Indian rupee, the prevailing rate according to the Indian rupee. So when they are translating their transactions to another currency, there would be some variation. See, the day when they have prepared, see, as on the date of disclosing the financial statements, when they prepare, they're in their domestic currency, that is all fine. But then once they have to translate it to Indian rupee, because the rate keeps fluctuating, the value of the transactions also will get affected. So any variation on account of translation to the parent company's currency is called as translation risk. First one is transaction, because they are involved in exchange of certain things. So if there is any risk which is involved, is called as transaction risk. Translation risk arises, it says that translation exposure is the change in the value of a subsidiary due to changes in exchange rates. This is an accounting risk rather than a cash-based risk, cash-based one. They are not making the payment here, but because the books of accounts, they have to make these changes. So because on account of that, any risk which arises is called as translation risk. Okay, translation or accounting exposure. It is only in the books of account, but yet the financial statement, the income statement values would be higher or lower, or similarly the asset values can be presented at a higher or lower, liabilities also similarly. So then we see that there is a variation. When the variation arises, we call that as a risk. This variation is on account of the financial statements of the subsidiary, which gets translated to the parent company. Okay, then economic exposure. So economic risk is the variation in the value of business due to changes in the exchange rates, causing a loss in competitive strength. In competitive strength, it says that the expected exchange rates can be predicted and factored into NPV analysis. That we will see that. Okay, it says that the because because of changes in the economy, the variation in the value of business due to the changes in the exchange rate, causing a loss in competitive strength. Just because the value of the foreign currency is varying, because it is varying, then we see that there is a loss in the competitive strength. So there is another slide also which expresses this, the loss of competitive strength due to changes in exchange rate. Because the exchange rates are varying, they would not be able to take up the same activity, because their competitive strength gets affected, because they would not be able to take it up in the same way, because there are changes in the exchange rate. That is called as economic exposure, because they're buying or selling goods, importing or exporting goods from other countries, and that has an impact on their payment or receiving because of changes in the foreign currencies. We call it as transaction risk. When the subsidiary has to translate their financial statements according to the currency of the parent company, any risk which arises is called as translation risk. Economic risk is when the variation of foreign currency is causing some impact or a loss on their competitive strength. They would not be able to take up the same course of action. We call that to be as economic risk. Okay. So when there are changes in exchange rate, we see that the exchange rate, changes in exchange rates, these result from changes in demand for and supply for currency. So why would they change? They would change because of difference in interest rate. See, in one country, if the interest rates change, increase or decrease, that has an impact on foreign currency. So one reason is because of changes in interest rate. If the interest rate is more in that particular economy, or less in that particular economy, so that will affect their activity there, in the productivity activity there in that particular country. Now if there is a possibility that interest can be earned, better interest can be earned, people would be involved in investing in some other type of investment rather than investing in the foreign currency. So the demand gets affected. people who were trading with the foreign currencies, they would not be so much because they can otherwise benefited from the domestic country. Therefore, there is a less demand. When there is less demand or when there is more demand, this could be a cause. This could have an effect on exchange rates. So depending on what is the difference in the interest rates, we see that there is an impact. Another reason is if there is an impact or if there is a change in the inflation rate. Okay, if the inflation rates are higher or lower, that can have an impact on if the inflation rates are higher, what do we see? That the buying power reduces, or inflation is not there, uh, that will have an impact on the foreign currency. So the foreign currency also will get affected because of the inflation rate. Then it says that difference between forward and spot rates. What does it mean by forward and spot rates? Now, if two parties A and B are entering into an agreement, so if this transaction is for, let's say that after 3 months, they would fulfill the obligation in the contract. Maybe some goods are delivered or some shares are delivered, something. So there is a buying and selling of something after 3 months. So as on after 3 months, so what is the rate at which they would be fulfilling? That is a forward rate. So they are looking at what is the rate after 3 months at which they will fulfill. That is as on that day. What did I write? 3 years. I meant it to be as 3 months. I wrote 10 years. After 3 months, then whatever is the prevailing rate as on that particular date, spot rate, or the rate what they have entered into the agreement as a forward rate. What is the difference between these two rates? So let's say that they have entered the rate that the obligation will be fulfilled at 50 per unit, whatever is that. But let's say that after 3 months, the rate is at 51 per unit. So we see that there is a difference of one unit of currency. Okay, per unit, one dollar or 1 rupee or whatever. That is the difference in the currency. That can also have an impact on exchange rate. What is the difference in the forward rate and the spot rate? Then expected changes in spot rate. Spot rate will get affected because why would it get affected? It gets affected because of the um, rates which are prevailing as on that day. Spot rate is the day rate which is there as on the future date. So let's say 3 months later, February, March, April, May. As on May 1, whatever is the rate which is prevailing there, because all these things are expected. These are expected, anticipated, that is a rate would prevail as on May 1. As on every particular date, there are expected values. So we call it as expected spot rates, expecting that they enter into an agreement. So when they enter into an agreement, but if it is not the same in the market as on that particular date, that will have an impact. That will have an impact on the risk which they are facing. So here it says that based on the expected expectation theory, they expect what would be the spot rate, the difference in the spot rate, or the difference in this expected changes in the spot rates, the difference between forward rate and spot rate. These are the reasons why there would be an impact on the exchange rates. So we will still try to understand better as we move forward. So why would there be changes in exchange rate? Because there are differences in interest rates, difference in inflation rates. There is a difference between the forward and the spot rate. The spot rate variations. Basically, the spot rate varies as what they have anticipated and what actually happened on that. These are the reasons why there would be impact or effect on the foreign currency. Okay. So we'll still better understand this one. Purchasing power parity theory. Purchasing power parity theory. claims that the rate of exchange between two currencies depends on the relative inflation rates within the respective countries. So purchasing power parity, basically purchasing power parity talks about what is the buying capacity, what can um, let's say that there is a particular item or a product, some item is there. Now if this item has to be purchased, if this goods or this service, this item has to be purchased, what is the purchasing power in each country? So how much can they buy this commodity in country one? So let's put it as this is the first country. What is the currency which is used to buy this particular thing? That is the capacity or the buying power or the purchasing power of this currency. To how many units should they spend? Then take the second country, country 2. How many units of their currency should they spend to buy this one? Okay. What is the purchasing power their currency has is taken to find out what is the exchange rate between these two. Let's say that country one is spending only 1 unit, $1. Let's put it as $1. Okay. Quickly let's see, $1 is equal to how many yens? It says it is 104 yens. So they would have to spend 104 yens if we are talking about, okay, if we are talking about yens, it is 104 yens. So they are if they have to spend 100 yens to get, let's say that this is some product X has to be purchased. Country one is spending only 1 unit. With $1 they can get that, but country two is spending 100 units to buy this particular product. So that is the purchasing power of their currency, how many units of their currency they have to spend to buy the same product. So that is put to test to understand what is the purchasing power of their currency between the companies, between the countries. So purchasing power parity theory, what does it talks about? Claims that the rate of exchange between two currencies depends on what is the power of their currency to buy this particular product. Purchasing power, how many euros should they spend? Let's say the same thing in India, country 3. India has to spend, let's put it as, maybe they have to spend 70 rupees. Unless and until they spend 70 rupees, they would not be able to get this one. So here, what are we trying to look into that? The exchange rate is dependent based on how many units of currency they have to spend to buy one particular commodity. So taking that, the buying power, so that could be based on maybe the prevailing inflation rate in that particular country. Okay, the prices are rising, therefore the price has increased. The prices are falling, therefore the price is at a lower. So what is the buying power of their domestic currency is considered to decide what would be the exchange rate. Okay, purchasing power parity theory. Okay, claims that the rate of exchange between two currencies depends on the relative inflation rates within the respective countries. Okay, so it is given as the predicts the country with the higher inflation rate will be subject to a depreciation of its currency. Depreciation, why are we calling? Because inflation, when it rises, more currency has to be used, because the prices rise to get the same commodity. More would be the quantity. Instead of 70, then the prices are rising, it will go up to 75. So when you are looking at in quantity is increasing, quality is not is decreasing. Is it not quality decreasing? That quality which is decreasing, we call it as okay. So depending on now, if the if there is inflation, if the prices rise, then what happens? What they were able to buy with 70, now they have to spend 75. So when they have to spend more currency to buy that particular product, then is there not quality of the value, quality of the currency decreasing? So that is called as depreciation of its currency. Okay. So to estimate future spot rates, there is a formula. Learn this formula. S1. S1 says that the expected spot rate. Now, based on what would be the rate in the future, they enter into an agreement, isn't it? So they enter into an agreement expecting the value of the currency to be at S1, expected future spot. S0 is the current spot, the rate which is prevailing as on the date when they enter into that, the current spot rate. Fine. It gets inflated, inflation rate in the base country divided by inflation country in the inflation rate in the other country. So considering the inflation rates, they decide on what would be the rate which will be prevailing as on a future date. So based on the expected spot rate, the parties enter into agreements. But then again, if there is, now they expect that yes, the rate would be something like this, and they enter into an agreement. It, just because they have expected, it is not necessary that the rate would be the same as on that particular date. It still can vary. So when it varies, when it fluctuates, then that is the risk what they would be facing. So here, how do they anticipate? They anticipate what would be the expected rate S1 as on a future date based on what is today's rate S0. Then considering what is the inflation rate in the base country, what is the inflation rate in the foreign country. Taking this calculation, they find out what would be S1. So after they expect S1, enter into an agreement. Okay. So to the base for that, the base for that is based on purchasing power parity theory. Purchasing power parity theory talks about if a particular commodity has to be purchased, what is the purchasing power of their currencies. So with $1, they're very powerful. With $1, only they can buy that. But some other countries, they have to spend more currency to buy the same commodity. So taking these things, the exchange rates are decided. What is the value of one thing as against another thing? Okay. So now the prices rise in a particular country based on the inflation rate. So if the inflation rates are rising, the prices also would rise. If they are not, then the prices would be stable. If they are falling, we see that, okay, considering the inflation rates in the base country, in the domestic country, and in the foreign country, the future spot rate is calculated with the help of this formula. Okay. There is another theory, interest rate parity theory. Interest rate parity theory. What does it say? It claims that the difference between the spot and the forward exchange rates is equal to the differential uh, between interest rates available in two currencies. The previous one was on account of inflation rate. The purchasing power parity was on account of inflation rate. Now here the change is on account of the interest rates in these countries. Okay. The forward rate is the future exchange rate. Okay. As on the future, what is the rate at which the transaction will be fulfilled is the forward rate. So forward rate is the future exchange rate agreed now. Now only they enter, now only they decide for the rate what will be. Let's say a farmer decides that per bag of wheat, he would be selling it at 100 rupees. Some example I'm giving. So per bag of his produce, he would be he would be selling them at 100 rupees per bag, something like that. So 100 rupees per bag, if he decides on that, the market rate can be 190 or 110, whatever is there, that because he's already pre-decided the rate. As on the date when the produce is sold, he would be selling because there is an agreement between two parties. He will fulfill his agreement at that forward rate. So the forward rate is the future exchange rate agreed now for buying or selling an amount of currency on an agreed future date. So in the future, so they would be buying or selling foreign currencies also. We know that foreign currency also is traded in the exchange rate market. So they can decide about, for X number of units of foreign currency, what is the price which would be paid or received. So that is the forward rate. Okay. Now here it says that the IRPT predicts that the country with the higher rate, country with the higher interest rate, will see its forward rate depreciate. Why would that happen? Logically, you think. There is country one. Country one has interest rate which is higher. Interest rate is at a higher, increasing or higher than the other country. Higher. We'll see forward rate depreciate. So forward rate would be less. Why do you think so? Is there any logic behind that? Only two of you are there, Ashley and Simran. Done. Because I think recording has spoiled the attendance. They are very comfortably thinking that they can follow the recordings and then not attend the class. But
Ma'am, Ma'am, I've messaged in the group that join FM class, but I think some of them, the juniors, they have to go to university. Might be that might be the reason.
see, as much time they are spending here, same would be the time which they have to spend to listen to the recording also. 1 hour will be recorded as 1 hour only. No, it will not be the condensed form. So same 1 hour now they are listening. Same 1 hour they will receive it. Listen to that later on also. They are not realizing that part of it. Okay. Um, so why would the forward rate decrease if the interest rates are higher? If interest rates are higher, then they will have better benefit of receiving interest at higher values in their country itself. In their domestic country only they can get benefited. So they would not look at these things. So it says that when an investor gains by investing in a currency with a higher interest rate, must be lost when changing the investment back to the home currency. Okay, so if the interest rates are higher, it says that the country with the higher interest rate will see its forward rate depreciate. What an investor gains by investing in a currency, whatever an investor gains by investing in a currency with a higher interest rate must be lost when changing the investment back into home currency. To calculate the current forward for 1 year's time, the formula given is FO is the forward rate, SO is the current spot rate, O is always the current period, which is defining the current period. It says that the interest rate in the base currency versus the interest rate in the counter currency. So if the interest rate in another country is rising, it may not be the same interest rate prevailing in the domestic country. So then when they are converting back to their domestic currency, it says that they must be lost when changing investment back into the home currency. So depending on this interest rate in country one, when the interest rate is better, when it is higher, okay, it says that the will see its forward rate depreciate. After that, this has to be again converted into the domestic currency. When an investor gains, what an investor gains by investing in a currency. So when he's investing into because the foreign country, the inflation rate, interest rates are higher, the interest rates are higher. So he would be investing in that and he gets benefited out of that. So whatever benefit he gets because the interest rates in the other country are better, that will be lost because the current domestic country currency, when it has to be converted, it because interest rates are not so attractive in the domestic country. So it says that whatever an investor gains by investing in a currency with a higher interest must be lost when changing the investment back into home currency. So that is another reason for an impact on the foreign currency, because two different countries have two different interest rates. Some country may have higher rising interest rates and another country may not have higher interest rates. So on account of that, when the interest rates are rising, okay, then investors would get attracted to invest in the foreign country, but once they get attracted, invest more into the uh, country with higher interest rates, okay, anticipating that the value would be the same when they convert it back into the domestic country. The domestic country rates are different. So the interest rate here we see that the base country interest rate in the base country IB and interest rate in the counter currency IO. Okay, when they are discounting at that thing, whatever benefit which was assumed will be nullified. Okay. Next, we see that the next theory is expectation theory. The expectation theory states that the current forward rate is an unbiased predictor of the spot rate at that point in the future. So just simply expecting what would be the value in the future. that is expectations theory. Expectation theory states that the current forward rate is an unbiased. You're anticipating, that's it. Okay, there is no bias in that. You're purely based on some understanding about what would be the rate. When you estimate the forward rate, it states that the current forward rate is an unbiased predictor. So based on this, when they are predicting the future, when they are expecting the future, that's called as expectation theory. Then we see another one which is called the international Fisher effect. Okay, this states that the interest rate differentials between two countries provide an unbiased predictor of future changes in the spot rates. Because of changes in the interest rates, um, between two countries provide an unbiased predictor of future changes in spot rates of exchanges. So we have understood about what is the purchasing power parity. Okay. Uh, then we have understood the purchasing power parity between two countries. Then we have understood about interest rate parity theory. Then because of the interest rate differentials between two countries, Fisher's effect, and purely expecting what would be the future spot rate. Okay, unbiased predicted value of the future rate. Okay, expectation theory. Based on all these reasons, we see that there is an impact on the exchange rates. Changes in exchange rates are on account of purchasing power parity theory, interest rate parity theory, Fisher's effect, both the Fisher's effect, international Fisher's effect, and the pure expectation theory. Now, risk is anyway there, that we have understood. So risk is present, done. How to manage this risk? The main topic here, what we are looking at as risk management. How do we manage the risk is the important point. Managing foreign currency risk. So what are the points here? Taking measures to eliminate or reduce a risk is called, okay, that can be done by hedging the risk or hedging the exposure to risk. There are certain, learn these terms. Terminology is important. You can be tested here about the terminology part of it. What are the various terms which are there? What are the practical approaches? Invoice in home currency and pay for all the imports in home currency instead of paying it in the so importing is current country one sends the goods and country two receives the goods. So country two has to make the payment. Goods are received, goods are imported. Let's put it as imported. Imported from country one, and payment from country two has to be made to country one. Payment has to be made. So instead of agreeing to make the payment in the foreign currency, so whenever the foreign currency fluctuates, the payment value also fluctuates accordingly. So the first approach is, for whatever are the goods which are received, the payment is agreed to be made on in the domestic currency. So when they agree to make the payment in the domestic currency, the payment is not subject to the fluctuations of foreign currency. So that is invoice. Invoice in home currency. Second one, do nothing. Do nothing and bear the risk. So whatever, just go with the terms and conditions. Okay, do nothing. So that is one way of managing the risk. Okay, sometimes no matter how much you put an effort, you still cannot do anything about that. So what do? You just accept it. Self acceptance, what we call it as. See, Japan is an advanced country. No matter how technologically the advanced they are, they still see that earthquakes happen there. So what are they doing? They're just accepting it. They are accepting and finding out another way of how to face situations where there are earthquakes. Okay, sometimes in a business also, no matter how many efforts they put in, they still cannot do anything about it. So what do? You just bear it. Okay, so that is do nothing and bear it, or self acceptance, that is. Then we see the next one is as leading. Leading and lagging are two different terms. Leading, changing currency early if it is estimated that this will be advantageous. Okay. And lagging says changing currency as late as possible if it is estimated that this will be advantageous. Lagging is you are delaying it. Lagging talks about you are delaying that. So the point here, it says that as far as possible, try to delay the change currency as late as possible if it is estimated that this will be benefited. So if they delay it a little late, they delay it, then maybe they are anticipating that the foreign currency would be beneficial for them, advantageous for them. That is, the variation in that would be will prove to be favorable to them. So they can delay that. Lagging is delaying. Leading is paying it early. Okay, changing currency early, and if it is estimated that this will be advantageous. So they can either take a lead in making the settlement, or they can delay it because they are anticipating some change will cause some benefit to them. Leading and lagging. Then matching inflows and outflows in foreign currency. Matching concept here talks about um, they ensure that as on the date when they have to make the payment, they also ensure that they get some cash flow because the current assets get converted into cash. So they just ensure that there are certain currencies which are available to them. If on as on a date, if a current liability has to be made, ensuring in such a way that a current asset gets converted into cash as on that particular date, so that this cash will be used to make the payment to the current liability. So that is the matching concept. Here also, ensuring that as on the date when the payment has to be made, there are certain cash inflows also. So matching inflows and outflows in the foreign currency. Okay. Then use foreign currency bank accounts. So when they have deposits in foreign currency bank accounts, um, then the payment can be made from the currency which is available there, so that they are not so much affected because of the fluctuations. So how is foreign currency risk managed? The exposure, the choices which are given are invoice in agreeing to make the payment in the domestic currency, do nothing about it, leading, making the settlement as early as possible so that it will be beneficial for them, or delaying the payments so that it will be beneficial to them. Then matching the inflows and outflows, ensuring that as on the date when the settlement has to be made, there is some amount of inflow. Then use foreign currency bank accounts to make the settlement. Now, what is the procedure of trading in currencies? Trading in currencies, definition is the foreign exchange market is an international market in which national currencies are traded. Trading is not only in case of shares and bonds. Trading also happens with foreign currencies. So it says that the foreign exchange market is an international market. So there is a market wherein the currencies are traded. So the national currencies are traded in a market which is called as foreign exchange market. Okay. What are bid and offer prices? Banks dealing in foreign currency quote two prices for an exchange rate. One is a lower bid and a higher bid. Okay. For example, a dealer might quote a price for sterling versus US dollar as a lower rate of 1.4325, a higher rate as 1.4330. The lower rate is the rate at which the dealer will sell the variable currency in exchange for the base currency sterling. The higher rate is the rate at which the dealer will buy. Okay. Lower rate is the rate at which the dealer will sell the variable currency. and higher rate is the rate at which he would buy. So the quotation is between the bid, with the bid or the quotation is mentioning what is the lower rate and what is the lower bid price and what is the higher bid price. The key point is explained here. Remember that the bank will always trade at a rate that is more favorable to itself. So obviously that is the rule of the business, that when the rate is favorable to them, they would take up the transaction accordingly. The difference between the bid and the offer price is known as the spread. Here in the previous slide we have seen that a dealer is willing to sell at a price, willing to buy at a price. It is his price. It is he's quoting those prices as a lower price and a higher price. The dealer is quoting. Okay, so he is bidding for the foreign currencies at a particular value. He's presenting that he would be selling the currencies as a rate, a lower rate, and buying it at a higher rate. Fine, it is his price. The difference between the bid, he's bidding, but the counterparty also will have the offer, isn't it? What is the offer of the counterparty? The difference between the bid price and the offer price is called as the spread. It represents the transaction cost and profits of the dealer in the currency. So the difference between that, so if it is beneficial, he gets benefited um, between his bid price and the offer price offered by the counterparty. As against the benefit, his costs, whatever some administration cost which he incurs, that he will be deducted. So that is the spread. Depreciation and appreciation of a currency. When one currency depreciates against another, the currency will appreciate. That is, quality reduces, quantity increases. As simple as that. Okay. If what is earlier bought with the 100 rupees, now if you have to spend 110 rupees, why are you spending more quantity? Why are you increasing the quantity? You're increasing the quantity because 100 is not able to buy what it was able to buy with 100 earlier. So the quality has reduced. So that is depreciation. It says that depreciation and appreciation of a currency. When one currency depreciates against another, the other currency will appreciate. So if what was done with 100, if it has to be done with 110, so earlier what was 100 spent as against 1 unit of another currency, now in place of 100 they are spending 110. So the other country will receive more quantity, so they will be appreciated. So earlier, 1 unit of one currency was 100 units of another currency. Now 1 unit of that currency is worth 110 units of another currency. So if the value is depreciating for one country, it is appreciating for another country. For instance, if an exchange rate between US dollar and the pound, Great Britain pound, moves from US dollar 1.5 to pound 1, to US dollar 1.4 to 1 pound. Okay. Pound has depreciated. Pound has depreciated against the dollar. It can now buy fewer dollars than before. Earlier, pound was able to get one for every 1 pound, $1.5. Now they are able to get only 1.4 pounds, $1.4. 1 pound is able to get only $1.4. So which one has depreciated? The pound has depreciated. Earlier, they were receiving $1.5 for every one single pound. Now they're getting lesser quantity. The quantity is reduced. The quantity is reduced is the ability of their pound is reduced. They are getting less value. Okay, it can now buy fewer dollars than before, and the dollar has appreciated against the pound. Fewer dollars are needed to buy pounds. Hedging with forward contracts. The spot market is where you can buy and sell a currency. Please learn all these terms. A spot market is a place where you can buy and sell currency. There is immediate delivery. A forward market is where you can buy and sell currency. Forward, which we are talking about. Spot is at the on the spot, as we say, on the spot, immediate. Forward market is where you can buy and sell a currency at a fixed future date for a predetermined rate. That is forward rate of an exchange. So what is a spot market? The immediate delivery takes place. Forward market is where it happens, the delivery will happen in the future date. That is a forward market. Okay. Then it says that at a future date for a predetermined rate, that is forward rate of exchange, quoted as a margin on the spot. Then it says that what are the advantages? Advantages include flexibility with regard to the amount, relatively straightforward. Disadvantages include contractual commitment that must be completed on the due date. Okay, so instead of buying and selling as on today, as in the spot market, instead of buying and selling it in the spot market, they're delaying that. They are deciding a defined period of time and ensuring that it will happen as on the future date. The forward market is where you can buy and sell a currency at a fixed future date for a predetermined rate. That is the forward rate of, so what is the advantage if you are not doing it immediately? It says that you will have a flexibility, you can make the arrangement within that date, and then say some kind of flexibility with that agreement. Then it is relatively straightforward, so all the terms and conditions which are mentioned, it will happen at that particular those dates and those terms and conditions. The disadvantages is you have to fulfill that, even if it is not favorable to you as on the future date also, it has to be fulfilled. So there is a contractual obligation, commitment is there, which has to be fulfilled as on the future date. No opportunity to benefit from favorable exchange movements. So because it has to be fulfilled, and it has to be fulfilled at the terms and conditions, so it may not be beneficial to fulfill that. So that is another disadvantage. Then we see a money market hedge, another thing. Money market hedges, hedging with the forward contracts is, instead of fulfilling the obligation immediately as in the spot market, they're delaying that to be settled in the future period. So it may be beneficial for them, it may not be beneficial, but as of now, they are postponing that to a forward market and fulfilling the obligation in the future date. That is a forward hedge, the hedging with the forward contracts. Forward is an agreement between two individuals. So there are two parties, party A and party B enter into a contract. They enter into a contract to fulfill an obligation at a price and a due date is there. The contract will have an obligation which will be fulfilled at a price on a future date. A date also is mentioned. So they have to fulfill this. But the disadvantage with the forward is, see, they are not traded in the market. The the exchange markets, they are not traded there. It is not secured form. It is a kind of an unsecured way of dealing with that. The chance of not fulfilling the obligation is quite high because there is no regulatory body. Anybody can enter into these kind of agreements forwards. Okay. So the chance of a default, the chance of not fulfilling this is quite high in case of forwards. Futures are traded in the exchanges. Therefore, if the parties cannot go back on their promise of not fulfilling it, no matter what it is, they have to be fulfilled. Forwards, we call them as over the counter agreements. So there, anybody can enter into that. There is no regulatory body which can supervise them. Fine. So forward, this is basically the convenience of entering into an agreement. Forwards. Fine. Then a money market hedge. Another way of hedging is by way of money market hedge. Instead of hedging a currency exposure with a forward, the company could use the money markets to lend or borrow and achieve a similar result. What is a money market? A market where short-term securities are traded. We know that. We've discussed the money market instruments. The money market instruments which are available, which are invested into for a period less than 1 year. Okay. So instead of going and entering into a forward contract, they can think about raising their funds or resources from money market. A company could use the money markets to lend or borrow and achieve a similar result. So if they have obligations to be fulfilled, instead of delaying that and fulfilling that through forward contracts, it also says that they can raise money from the money markets for short-term period. Okay. To hedge a payment, buy a present value of the foreign currency amount today at a spot rate, that is immediate payment in sterling, and may involve borrowing the funds. So today, if they have to buy this currency, there's something which is mentioned, sterling. If they have to buy sterling as at the spot rate, today's rate, the present rate, if they want to buy that, borrowing the funds from the money market, short term. Okay, borrowing the funds from the money market. Place the foreign currency on deposit where it will accrue interest until the settlement date. Use the deposit to make the foreign currency payment on the settlement day. So meanwhile, what are they getting benefited? They are getting benefited on the accrued interest on the foreign currency. So there is an example which is presented here. Borrow funds from the money market for short-term period. Purchase the currencies. Take these currencies and deposit somewhere where they can earn some interest. And as on the settlement date, when the money market instrument has to be settled, it's a short period, let's say 6 months period. So buy these currencies and deposit for 6 months period, and during the 6 months period earn some interest rate, and as on that date when it has to be settled off, convert this foreign currency and pay back this cash amount to the money market instrument and clear that debt. What is that their benefit is? They've been earning that interest. They were earning that interest on the deposit of the foreign currency, accrued interest. That will be their benefit. So this is another way of hedging. So hedging with the money market. Okay, to hedge a receipt, borrow the present value of the foreign currency amount today. This is when then translated at the spot rate, giving an immediate receipt in sterling, which can be invested. So the receipt which is received can be invested. We have also seen this concept of invoice being sent to the factor, and as against the invoice, the factor extends amount or I mean clears at least 80% of the invoice amount to the seller. We have understood this concept of based on the receipt. So here also we have this concept that borrow the present value of foreign currency amount today. This is then translated at spot rate, giving an immediate receipt in sterling, and this can be invested. Fine. Then the foreign loan accrues interest until the transaction date. The loan is repaid with the foreign currency receipt. Okay, that is another example based on the hedging with the receipt. Then likewise, hedging with forwards, similar is with hedging with futures also. Both of them are all the points are similar between forwards and futures, except that futures are more secure way. Futures are like forward contracts but are for standardized amounts, can therefore be traded on currency exchanges. They can be traded. There is a platform there. So there are regulatory bodies involved. So there is no going back on that. They have to fulfill the obligation. But in case of forwards, that monitoring, that regulation, regulatory bodies are not there to regulate the transaction. So we see that risk is more high in case of forwards not being fulfilled, but futures can be because there is someone to guide that, they are more secure. Okay, so they can also hedge their transactions with futures. Right, that is settling the amount at the future date, is as on a future date in the future period, as on a date uh, at a rate which is pre-decided, the obligation will be fulfilled. Then another type of derivative, when they enter into an agreement, the value is derived from an underlying asset. So there is some asset which is the base. Based on the value of that underlying asset, asset could be anything. Asset here in this case, we are taking it as foreign currency. Foreign currency is an asset. Based on the foreign currency, the value which is decided for the derivative, we call, for the agreement, we call it as a derivative. The value of the underlying asset will be taken to decide what is the price of the derivative. So one type of derivative is forward, another type of derivative is future, a third type of derivative is called as option. Okay, here the writer of the option, the owner of the option, uh, whoever owns the options, the owner of the option has the right to fulfill the obligation or not fulfill the obligation. So the owner has the option to either buy or sell. Option may be the technical terminology what we use is options are put options and call options. When when it is a put option, the option is to sell the currency. They they may sell it or not sell it. If the title is called as put option, and if the contract has an obligation to sell at a particular date, as on that date, if it is not beneficial, he has an option not to sell also, sell or not to sell, right? Okay, so it is considered as his right because he has the option. He would sell it or he would not sell it. So if it is beneficial, he has a right to sell it. Otherwise, he has an option not to sell it also. So that if it is involving sale part of it, selling, we call it as put option. If it is about buying, the right to buy, we call it as call option. Call option is about buying. Put option is about selling. Options give the right but not the obligation. That is the important point what we have to remember. Options give the right but not the obligation to buy or sell a currency at some point in the future at a predetermined rate. The option therefore eliminates downside risk but allows participation in the upside. So if it is not favoring them, they have an option not to exercise it. If it is favorable, they would exercise it. If it is not favorable, they would not exercise it. if they are not exercising it, the other day also I told you, if they are not exercising it, the counterparty gets affected. The counterparty would not be benefited. In such situations, because they are not fulfilling that, as against that not fulfilling, they would have to pay a premium. A premium must be paid to the per to purchase an option, whether or not it is ever used. So they would be paying a premium amount. So premium amount is what the owner of the option would be paying to the counterparty. That is another important point what we need to remember. The next concept is interest rate risk. Now till now we've discussed about what is foreign currency risk, foreign exchange rate risk. Now it is interest rate risk. Interest rates keep varying, fluctuating from time to time. Like foreign currencies also fluctuate from time to time. We see that interest rates also fluctuate from time to time. Interest rate risk is the risk of incurring losses due to adverse movement in interest rates. Because of the fluctuation in the interest rates, if there is any loss which is arising, we call it as interest rate risk. Exposures to interest rate risk can be hedged. There are several methods of hedging the risk. Hedging is minimizing the loss, mitigating the loss. We call that as hedging. Okay. So when there are fluctuations in interest rates, there may be losses arising. If there are losses arising, these losses can be minimized by way of hedging. What are the ways of hedging? Exposure to interest rate risk can be hedged. There are several methods, and these are the methods. First one is entering into a forward rate agreement. They decide upon a rate at which the payment would be made in the future period. Forward rate agreements, FRAs, forward rate agreement. The rate of interest is decided and which will be fulfilled as on a future date. Okay, that is forward rate agreement. Second is enter into interest rate futures. So futures, I have explained that is traded in the exchanges market. So that is kind of secure. So they can also enter into agreements involving futures, interest rate futures. They may also enter into a derivative agreement based on interest rate options. Then a fourth type of it is called as swap. They swap one with another thing. I'll explain that in a while. So what are swaps? Definition. What is the basis risk? Basis risk is the interest rate exposure which is not eliminated by hedging. So even if you are managing, mitigating, reducing the loss also, if anything which is not eliminated, we call it as basis risk. Something like leftover. In spite of managing it effectively also, if it is still something is still remaining, that is the basis risk. Okay. You cannot always eliminate risk. You can only manage it. You can only control it. You can reduce it. In spite of reducing, managing, mitigating also, if there is still some more risk which is present, that's called as basis risk. There is an yield curve. When you learn about the bonds, there are various theories which you learn. Maybe some other time, some other paper, you would be learning that. And they get affected because of the interest rates. Interest rates are not always fixed, they are fluctuating. So when the rates in the market fluctuate, because entities enter into agreements involving fixed rate, like in case of bonds, see, when they are issued at a fixed rate. Okay, during the entire life of the bond capital, you see that the interest amount which is paid to the investors is at a fixed rate, but the investors will be affected because the market interest rates are rising. When they are rising, they are at a loss because they will continue to receive interest at that fixed rate. But whereas the market, if they would have invested in the market, interest from the market is at a higher amount. If the interest rates are falling, they are benefited. So we see that there is a impact of the fixed interest rate, there is an impact of the floating interest rate. So as the interest rates keep fluctuating, if the payments have to be made at the fluctuating rate, then they may be benefited when the rates are rising. They would not be benefited if the prices of rates are falling. So also when there is an agreement, when they are entered into at a fixed rate, as long as the rates are falling, they are benefited. If the once the rates are rising, they would not be benefited. So we see that there are pros and cons of both types of interest rates, fixed rate of interest and floating rate of interest. Okay. The yield curve, also known as the term structure of the interest rate, a relationship between interest rate and the time to maturity. So here it is, there are the two variables are mentioned as time to maturity, which is presented on the x-axis. As the time period keeps extending for a longer period of time, years to maturity. See, for a shorter period of time, the benefit what can be derived is lower. But as the time period extends, the years to maturity extends, we see that the yield or the return is increasing. Okay. So for a shorter period of time, we see that uh, the gross redemption yield is at a lower. As the number of years to maturity keeps increasing, it rises. It says that it is normally accepted that the longer the period to maturity for a debt, the greater the yield on return than the debt must offer. That the debt must offer. See, shorter period of time, we've learned in terms of working capital when we were looking at investing into current assets. The sources are both current liabilities and the long-term liabilities. We've discussed about that. So long-term liabilities, the cost is high. Current liabilities, it is cheaper, but the risk is higher because they have to be paid in a short period of time. Long-term liabilities, the cost is high, but the benefit is they need not be paid immediately. That is what we were looking at when the amount has to be invested into current assets. So you remember that logic. So the benefit or an investor will receive from investing it for a long term period is higher than investing it for a short term period. That's the concept. The number of years to maturity, as they increase, the benefit, the cost for the company increases, so it is a benefit for the investor. So from long term investments, the long term investments give higher yield or higher return, higher profitability is there in case the term to maturity increases. The longer the period to maturity for a debt, the greater the yield on return that the debt must offer. A debt that matures after many years has more risk associated with it than one maturing soon. You know this concept because we've discussed that when we were discussing it about working capital management. The gross redemption yield reflects the overall return earned from holding the debt, including the interest yield together with eventual redemption value. As the number of years keep increasing, we see that higher return can be anticipated from that. Okay. So what are the factors affecting the shape of the yield? Okay. Factors affecting the shape of the yield curve. One is liquidity preferences, expectation of interest rate movements, and market segmentations. Liquidity preferences, to convert them back into cash. So um, what is their option of liquidating it, or what is the term period? Again, it comes back to how quickly they want to convert it back into cash. Second one is the expectation, purely expecting what would be the interest rate as on a future period of time. Okay, market segmentation, it's about what is it? What are the we've understood that the as the term period extends, the maturity years to maturity increase, we see that there is an impact on um, the yield rate. The rate of yield is increasing as the number of years to maturity keeps increasing. Then we see that liquidity preferences, now the factors affecting the shape of the yield. What is that the customers, the investors prefer about their liquidity? How quickly? So they decide about the term period, how quickly they want to get back their amount which is invested into the investment. So how quickly do they want? Okay, then expectation about what is that they are anticipating the future interest rate to be, that is another reason. Market segmentation, in a market segmentation theory, um, we see that various investors are there who would go with investing into different they get attracted to different types of investment patterns, short term investment, long term investment. So when we see that different types of investors looking at different maturity time periods, then some of them may be interested towards um, short term positions, some of them medium term, some of them long term. So depending on that, whether it would be many are seeking to invest in only short term, many are investing into long term. So what is their expectation from or what is that they are looking at, what are the various types of investors, are they focusing on investing it for short term or long term or medium term? That also will have an impact on what would be the shape of the yield curve. We have discussed that the yield curve will take this form wherein initially it is not rising much, but as the time period extends it is rising as the time period is extending. But if investors from the market are um, expecting different things, that will also have an impact, because if many customers are willing to stay for a longer period of time, then that security that it need not be liquidated immediately from the company's point of view also will consider, and they will continue to offer a higher rate. But if their expectations differ, then that will have an impact on the shape of the yield curve. Implication is given. Implication says that short-term finance is usually cheaper than long-term finance. We have understood that earlier also. Short-term finance is cheaper than long-term finance. So instead of fixed rate 10-year loan, it should be cheaper to get a 5-year loan, followed by another 5-year loan. So they can go for raising two short-term periods instead of waiting for long-term one loan. Long-term is again a costly. So instead of that, go for splitting the time period into two short periods. To first 5 years, a cheaper rate. then again redeem it and take it back, and then again go for a second 5-year loan. So that is the pattern what is suggested. Now, what is it? What is the meaning of hedging interest rate risk? What is the meaning of hedging interest rate risk? First one is entering into forward rate agreements. Forward rate agreements for interest rate. Forward rate agreement for interest rate is a financial instrument that can be used to fix the interest rate on a loan for a deposit starting at a date in the future. When FRA reaches its settlement date, the buyer and seller must settle the contract. Then the fixed rate in the agreement is higher than the reference rate which is prevailing in the market. This is based on LIBOR. LIBOR is London Interbank offer exchange offer rate, that is LIBOR. The buyer of the FRA makes a cash payment to the seller. If the fixed rate in the agreement is lower than the reference rate, the seller of the FRA makes a cash payment to the buyer. So they are entering into a forward rate agreement based on the criteria here is what is the rate of interest which is prevailing. So two parties enter into an agreement. Fine. There is a buyer and a seller. So it says that if the agreement is at a fixed rate, then they compare the rate which is there in the FRA versus the prevailing rate in the market. Simple, prevailing rate in the market. That is based on LIBOR. So that's a technical terminology which you have to remember. The buyer of the FRA makes a cash payment to the seller. Okay, the buyer will make the difference in the fixed rate and the prevailing market rate. The fixed rate in the agreement is higher. Rate in the agreement which is fixed and a floating rate. The market rate is floating, the prevailing market rate is floating. The reference rate or the rate of LIBOR, the prevailing market rate, when they are compared, the fixed rate is higher fixed rate, more amount of interest has to be paid. Okay, because this is higher than the prevailing rate. So whoever is the buyer of this FRA, because the buyer will be under an obligation to make the payment to the seller. So the buyer will pay the difference between the fixed and the LIBOR, because fixed is higher, the difference will be paid by the buyer. If this is falling, if the fixed rate is lower than the prevailing rate, so he will have to pay a lesser. So rather, the seller of the FRA will make the cash payment to the buyer. That is a forward interest rate agreements, FRAs. Okay. At 2 to 5 FRA at 5 to 470 means the agreement starts in 2 months time and ends in 5 months. So the first part of it denotes the time period. So the first part of it talks about the time period 2 to 5. The agreement starts in 2 months, ends in 5 months. 5 to 4.7 means the rate of borrowing is 5%. The rate of lending is 4.7. These are the terms of. Okay. Now, definition of an interest rate guarantee. Interest rate guarantee is an option on an FRA and protects the company from adverse movements while allowing to take advantage of favorable movements. That flexibility means they are more expensive than FRAs used when unsure as to which way interest rates will move. So ensuring, guaranteeing some amount here, interest rate guarantees, that is what it is mentioned. An interest rate guarantee is an option on an FRA. So they can have this option also included into the FRA, that there would be some amount of interest rate guarantee from an adverse movement. But it says that their flexibility means they are more expensive than FRAs. FRA is a future date obligation which has to be fulfilled. But because of the fluctuations in the interest rate, one party gets benefited, another will have to face the adverse movement. To protecting against that, if they enter into an interest rate guarantee option included into FRA, they can be insured, but sometimes it may be proven to be as expensive. Like interest rate forwards, they can also have interest rate futures, which are standardized exchange traded derivatives contracts. Interest rate futures are standardized exchange traded contracts agreed now between buyer and sellers for settlement at a future date. There are two broad types of interest rate futures: short term interest rate futures, STIRs, and bond futures. Bonds are for a longer period of time. A future contract is a promise. If you sell a future contract, you have sold the promise to make interest payments in future. The borrowing is notional. Technically, nothing would be borrowed, but only you understand that, no? What is notional? Nobody is borrowing anything or lending anything, but the agreement is based on a defined sum. Let's say 10 lakhs is borrowed. So as much as on 10 lakhs, whatever is the interest rate, the difference in the interest rates are taken and they are trading with that. That that amount of 10 lakhs is notional. There is no amount of borrowing of 10 lakhs. Assuming that amount to be 10 lakhs, they enter into an agreement. They say that on 10 lakhs, whatever is the interest rate, okay, so that the buyer will promise that he will make a payment to the seller at the end of the period based on the prevailing interest rate. So there is a fixed interest rate, there is a prevailing interest rate. So the buyer will promise to make the payment at a fixed interest rate. Then they compare it with the prevailing interest rate. Okay, buyer will have to pay at the fixed interest rate. So if the buying rate is higher, he will pay the difference between the fixed interest rate and the prevailing interest rate. If it is not the case, seller will have to pay the difference between the prevailing interest rate and the fixed interest rate included in the futures. So that is how we know the stock markets and these exchange markets. This is how they transact. That is what happens in these markets. So it says that the borrowing is notional. There is no real amount which is actually technically borrowed, nothing, but defining an amount on that, whatever are the terms and conditions, we see entities trading with them. The position is closed out by reversing the original deal. Learn these are the terms which are there. The two contracts then cancel each other out. The only cash flow that arises is the net interest paid or received. So there's no borrowed amount. The only thing what happens is what is that which is exchanged between the buyer and seller of these agreements. Another type of derivative is called as swap. Swap is another type of derivatives. Okay. An interest rate swap is an agreement between parties to swap a floating rate stream of interest payment for a fixed stream of interest payment and vice versa. They can be used to hedge against adverse movements in the interest rate. Let's say that there is one entity A. A has entered into an agreement. A has entered into an agreement with another counterparty B at a fixed rate. Okay. when A is entered into an agreement with at a fixed rate of interest, so fixed rate he would be benefited as long as if A has to receive interest at a fixed rate, as long as the fixed rate is higher than the prevailing rate, he would be benefited. If the prevailing rate is higher than the fixed interest rate, A will not be benefited because he would be receiving less than that. So then vice versa with B. B will be benefited as long as, because B is the one who's paying the interest, B will be benefited as long as the fixed rate is lower than the prevailing market rate. Okay. But it can, future is uncertain, anything can happen. Now they have entered into an agreement at a fixed rate. So there is a risk of the floating rate being changing. So A also will find a counterparty, will enter into another agreement at a floating rate. So finds a now because B is getting affected, B also finds another counterparty from the market, so finds another party and enters into another rate at a floating rate. So here we see that they are swapping one with another thing. Since they have entered into a fixed agreement, they want to swap the cash flow possibility by entering into another agreement at a other rate, a fixed rate and a floating rate. Since they have already entered into an agreement which involves a fixed rate of interest payments, they would want to find another party from the market to enter into another agreement which is at a floating rate, or if they have already into a floating, they would enter into. So one set of cash flow, one fixed cash flow is swapped against another floating cash flow. So one cash flow is swapped with another cash flow so that they can minimize the risk which is arising because of the fluctuations in interest rates. This is a concept you just have to learn. You don't have problems which you have to work out on swaps. An interest rate swap is an agreement between two parties to swap a floating rate stream of interest payments for a fixed stream of interest payments and vice versa. They can be used to hedge against adverse movements in interest rates to obtain cheap finance. Okay, so that is the explanation of currency rate risk and interest rate risk. Okay, mostly conceptually you will be tested. You will be, so I have included additional slides which have the definitions also. So earlier the slides we were following, some of the concepts are not clearly explained. So I have included few more slides into this PPT and I have elaborated the explanation. Fine. Please go through this and then listen to this many more times and then get this concept cleared.
Okay,
So
ma'am.
yes, two of you were very sincere. Seriously, you have taken these classes, attended all the classes, sessions. Simran once or twice because of, I don't know, some obligation, you were not there. But
Yes,
Ashley,
ma'am.
I
I
could
was not
see,
at my home.
I know, you told me also. Ashley, I see that was very sincere and attended all the classes. Continue this in terms of preparation also. Okay, this topic theoretically be sound in terms of learning all the terms which are included. So I have brought the definitions and pasted here into this PPT. Today, when I'm sending all the PPT, the recordings, I will send this PPT also. You have my number with you. You can please, I'm there on WhatsApp also. You can send a message
Okay,
if
ma'am.
I'm not immediately responding. I will definitely respond. Okay.
Ma'am,
Start
may I
your,
just send you a message now?
yeah. Yeah, please.
so that you will be able to
Okay.
recognize
Yeah.
during the
Please, 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 please.